everyone. I'm Bernard Young, the president of ABFER. I would like to welcome you all to today's academic keynote by Professor Steve Davis of Chicago booth on stock market reaction to the COVID-19 pandemics. For those in North America, thank you for joining us. I know it's getting late, but you will be excited to learn from Steve. We really wish that we could be in person, we could meet in person in these sessions. Still, I thank you all for zooming in. Your participation is really very endearing to us all. By the way, let me remind people that if you want to raise questions or make comments, please put them through the chat box. Before I introduce the speaker, I would like to thank the GIC of Singapore for sponsoring this event. As always, ABFER is very grateful for GIC's generous support that allow us to host events like today's. Now let me introduce the speaker, Professor Stephen J. Davis. Steve is the William Abbott Distinguished Service Professor of International Business and Economics, the University of Chicago booth. He's also a senior fellow at the Hoover Institute, research associate of the NBER, and he is an EXCO member and senior fellow of ABFER. He co-organized the Asia Monetary Policy Forum held annually in Singapore, which is now getting a lot of good attention. Steve has made many accomplishments. He made major contribution in the studies of business dynamics, and many of us have read his books and his work on job creation and destructions. And recently, we are really full of admiration of his work on the effect of economic uncertainty on economics. His widely cited research appears regularly in top economics and policy journals. So very deservedly, he's an elected fellow of the Society of Labor Economists. And also in 2013, he received the Actington Prize in Measurement, awarded by the Fraser Institute for Public Policy for his work in measuring economic policy uncertainties. Indeed, he is also a co-creator of the Economic Policy Uncertainty Indices, and you can find them on his web and so on. Feel free to use them. I hope it's for free. I think it's for free. And on the policy making and practice side, Steve has done so much that I don't think I want to take too much of your time to talk about what he has accomplished in that front. But I would just suffice to say, I think it's suffice to say that Steve has served as advisor to the U.S. Congressional Budget Office and as a senior advisor to the Brookings Papers on Economic Activities. Steve, thank you for doing this late at night. We are very eager to learn from you. Stock market reactions to the COVID pandemic is in many of our day-to-day conversations. We all have an opinion, and it would be great to hear what the scientific approach is that you have in this topic. Thank you. Steve, the floor is yours.
Thank you, Bernie. It's a real pleasure to be here. And as you indicated, the only thing that would be better would to be able to do it in person. So next year, that's what I'm looking forward to. So let me start with a bit of context that I'm gonna. And by the way, I'm gonna draw on work I've done with a large list of collaborators who are listed at the bottom of this slide. I won't read all their names. Just indicative of the fact that the work I'm going to talk about today reflects a team effort. So here's a bit of context, and I think you know some of this already, but I want to impress upon you a few things about really the extraordinary context in which the stock market has behaved in early 2020, which is the period I'm going to focus on. So here's the first piece of context, which is the global stock prices fell about 40% in a period of about less than 4 weeks. Okay, you can see on this chart. That stock price decline, the bulk of it preceded the decline in economic activity, as measured by the high frequency types of measures we have, like this is Google Workplace Mobility here. So the first one is just the magnitude of the global drop. The pattern that I'm showing on this chart here, basically across the 35 countries we've looked at, only China, Taiwan, and South Korea depart materially from this pattern in various ways, not tremendously, but this is a global phenomenon. That's kind of the point, first point I want to leave you with. The second point is just, I'll make an assertion, which we can talk about in the Q&A if you like, which is that the size of the stock market drop over this 4-week period in February and March is much greater than you can rationalize with a standard asset pricing model. Say, take Barrow's rare disaster model. I'll just assert that again. We can come back to that later. And when I say rationalize, I mean it's too large relative to any reasonable expectation of the size and the output drop that was precipitated by the COVID pandemic. The third piece of context I want to leave you with, and here this is data for the United States. If you take a look at the top chart, this goes back 120 years, and it basically shows you that in terms of realized market level volatility, the coronavirus pandemic was one of the great volatility episodes in the last 120 years. A different metric of volatility that's kind of more closely tied to what I'm going to talk about today is the number of large daily market moves. So if you define large as a 2.5% move in the S&P 500, up or down from the close of one day to the close of the next day, there were more such large moves in March of 2020 than in any period in US history back to at least 1900. So that's a different volatility metric. And then I also want, and this I think might be a bit surprising, I think you probably already know most of what I've told you so far. This might be news. There's no previous episode in the United States back to 1900 or in China back to 1990 in which the stock market reacted to a pandemic in anything remotely like the way it reacted to the coronavirus. So what's done in this chart, and I've done something similar with my co-authors for China back to 1990, is to take every large daily move in the stock market, defined the way I described before, and to read next day newspaper accounts of what, according to contemporaneous observers, moved the market. There were more than 1,100 such events before COVID hit in the United States, going back to 1900. Next day newspaper accounts attribute exactly 0 of them, 0 to pandemic events or policy responses to pandemics. And that includes the Spanish flu. In this brief period from late February through the end of April, there were 27 such events, an extraordinary number, and 25 or so of them, 24 of them, were attributed in next day newspaper accounts, this is in the Wall Street Journal and the New York Times, to either the economic fallout of the pandemic or policy responses to the pandemic. So again, that's the sense in which the episode in the early part of 2020, it's not just that we had a lot of market volatility, but that the pandemic played a role unlike any other pandemic had played in history, at least back to 1900. Same story for China. Okay, and now with that context, let me zero in on a bit of data description at the firm level, because that's going to be the focus of the rest of my remarks. So let me tell you what you see on this chart. I've got daily average market returns, valuated equity returns in the United States on the horizontal scale, and the cross equity security interquartile range of, so these are basically the IQR of the firm level equity return responses on a daily basis. The gray dots are every trading day in 2019. So that's just kind of a point of reference to evaluate what happened in 2019. You can also see I've fit this nonlinear regression to the gray dots. And you can see it's quite nearly symmetric around its intercept point. When it says something very basic, it's just summarizing something you would have guessed, that when the market moves a lot, there's also more heterogeneity across firms in what happens to the firms. The other thing I want you to focus on, the main thing I want you to take away from this picture are the colored dots, the big dots. Those are all the jump days, as I will refer to them, in this period from February and March 2020. And I'm showing you there for those jump days, again, the daily term return and the IQR of the firm level returns in the cross section. Again, these are evaluated numbers. And I want to point out how extraordinary the dispersion is. So I pointed to two numbers, and just to give you an idea that the interquartile range on those two dates that I point to with the green arrows are 15 standard deviations greater than the average IQR in 2019. And you can see in this chart there are several other kind of 10 standard deviation, 10 sigma events of this sort in these 2 months, and a number of others that are 3 or 4. So this period that I'm going to focus on in the rest of the talk, you should think of, there's this backdrop of enormous overall market volatility, but then there's this tremendous dispersion. And it's that dispersion in firm level returns that I want to try to explain. And so here and for the rest of the talk, I'm going to turn to a recent paper with Stephen Hansen and Christian Seminario, in which we do the following. We go to the text in 10K filings, and we use that text in various ways to characterize firms' self-perceived shock exposures or risk exposures based on things they wrote long before the pandemic struck, okay? So then we're going to use those exposure measures to try to explain or account for firm-level return reactions to market-moving news. And the market-moving news is the news that generated those big jumps that I talked about a minute ago in 2020. And here, let me back up and make one more observation from this picture. These dots are color-coded. They're color-coded based on the next day newspaper explanations or interpretations of what generated the market move. So I'm going to be using that classification. This is from earlier work and with Baker and others. I'm going to be using that next day classification when I go to the firm level data. So I'll be looking at COVID economic fallout days. Those are the red days. Those are the most numerous runs. But I'll also separately look at fiscal policy stimulus days, monetary policy easing days. I'll mainly in my talk focus on the COVID pandemic days, but in the paper itself, we apply the same methodology to each of these sets of days that I'm going to talk about. And I will think about those days as those market moves as triggered by in the case of the red dots, COVID-19 news, and then I'm looking at the cross-sectional reaction to that on those days, and I'll have a different cross-sectional reaction on the blue dot days or the green day or something. At least I'll allow for that. In fact, the data say very strongly they want that different reaction on those different jump days. Now we take two approaches in the paper. One's using expert-curated dictionaries, an approach that's been around a long time. A second approach is TADDY's implementation of supervised machine learning. For those of you who attended TADDY's masterclass, maybe 3 years ago or so, at the ABFER, I'm using the multinomial inverse regression model and methods that he described there. And we're going to try to extend them in one interesting interpretive direction that I'll talk about. So what do? For each firm, each listed firm on the U.S. exchanges, we go to their 10K filings and we look at their narrative descriptions of their risk factors. That's our text source. We're going to look at these text sources from the period 2010 to 2016, so well before the pandemic. So we think of what we're doing here is characterizing an ex-ante perspective on the kinds of shocks that firms see themselves as exposed to, as expressed in their 10K filings. And the idea is we're going to take this text content and see how far it can help us explain abnormal firm level returns on those jump dates that I talked about. So the dictionary approach works like this. We're borrowing dictionaries from Baker et al., so we're not constructing our own dictionaries, but think of these as basically expert-curated term sets. Each term set is supposed to capture a particular type of exposure category. We'll have about 36 of these. Roughly half of them pertain to general economic and financial conditions. I'll show you some of them shortly, and the rest pertain to policy areas. So here's some examples. So the inflation category, that's one of our dictionaries. It's got the 4 terms listed there: CPI, inflation, gold, and silver. Okay, so then we have others for commodity markets, monetary policy, and so on. There's, like I said, 36 of these. What we're going to do is we're going to go to the text, the 10K filings, the text in the 10K filings for each firm. And in the risk factors discussion, we're going to identify all sentences that say contain one of these words. And if it's a sentence containing one of these words, we'll say, well, that's a sentence about inflation risks as perceived by that firm, or its exposure to inflation risks, I should say. And we'll count the fraction of all sentences that the firm expresses that are about inflation. We'll do the same for commodity markets. So it's a very simple approach to calculating each firm's exposure to these 36 categories. And then basically I'll run a very straightforward abnormal return regression that has standard industry fixed effects as controls, a measure of the firm's market cap as another control, a measure of the firm's leverage as a control, and then we'll have these 36 exposure measures. Again, the exposure measure is the fraction of the text in the firm's risk factors discussion that contains a word in that exposure category. And I'm going to fit these regressions separately by jump day. There's roughly 20 of them or 17 of them. I don't remember exactly how many. But I'm also going to, in some of the exercise, pool over the jump days of a particular type, like all of the COVID-generated jumps, and focus on the average abnormal return on those jump days. So that's very straightforward. If you do that, and I'll just show you a flavor of what comes out. If you pool over all the 9 COVID-19 jump days, and this is abnormal returns relative to a CAPM model, fit to data, daily data in 2019, okay? So all of the things you see listed here are included as regressors. These are the exposure categories. Just for the sake of visual clarity, I've left things blank if it was a statistically insignificant effect. You can look in the, that's just so you can kind of focus on what matters. And there's 2 things I want you to take away from this table. First is to note that the exposure categories that matter and how they matter is very different on the COVID-19 and economic fallout days than it is on the monetary policy easing days, okay? You can see the inflation category, for example, actually shows up as statistically significant on both days, but the magnitude is quite different and the sign's actually opposite, okay? So a firm that has a certain amount of concern expressed in its 10Ks about inflation will react very differently to monetary policy easing than to bad news about COVID-19. The other thing I want you to notice is the adjusted R-squares. They're quite large, at least you can tell me if you disagree. They strike me as quite large relative to, given that we're just focusing on abnormal returns. And so we're accounting for about 1/3 of the variation with this very simple statistical model. And remember, the variation we're talking about is enormous. Okay, so that's the dictionary-based approach. Very straightforward, very transparent. Now, what about the TADDY approach? The TADDY approach says, let's think of each one of these firms' texts in its 10K filings as a bag of words. Let's represent it as a V-dimensional vector, where V is the number of all of the terms that appear in any of the risk factors texts, the so-called corpus. There's about 19,000 such terms. And then we're gonna let XIV denote the count of a particular term or feature, if you like the machine learning terminology. XIV is the count, the number of times that term, that feature appears in the text for the ith firm, okay? So we've got 2,000 some hundred firms here. Well, that's just a coincidence. The average number of non-zero elements for a given firm is about 2,200 with a standard deviation of 891, okay? And different firms are loading on different elements of this big V vector. Now the approach here is to think of this frequency count as being satisfying a multinomial probability vector in which the probability of drawing a particular feature for firm I depends on the baseline frequency of that feature in the overall corpus. That's what alpha V is picking up, plus this vector. And what's in this vector? All of the standard controls like industry fixed effect, the financial characteristics of firms, and the abnormal return for that firm. Okay, so this is the inverse regression because it's not quite what we want. It's not relating returns to what appears in the text. Instead, it's using the returns and the other variables that describe the firm and so on in order to model the frequency with which a particular term appears in that firm's 10K text. Okay, but we fit that. Now that's a high dimensional model, so we're going to fit it with Bayesian regularization methods. And here we're leaning completely on Taddy here, so there's no innovation. We're just taking his methods off the shelf. And then we're going to lean on Taddy in one more important way, and this is what I understand to be a significant innovation in Taddy's work. He shows the following. You can, after you fit that high dimensional model, that so-called inverse regression, you can reduce the information value about returns conditional on the other things that are in the regression, the industry fixed effects, the financial controls and so on, to a scalar. And that that sufficient reduction projection, which is going to appear as a regressor in the forward regression, I'll show you shortly, is basically summarizing all of the information in the text that's useful for explaining returns, conditional on these things. Okay, so that's the magic, so to speak. You're reducing all this. You know, remember we started out with a vector of 19,000 different frequencies for each firm. Now, then I can run the forward regression. What does the forward regression looks like? Looks like just the regression I told you about before, but instead of a bunch of exposure categories, now I've just got this sufficient reduction projection. Okay, so that's the approach. Now, this MNAR approach is much more flexible, and you might think it fits better, and indeed it does. But we'd like to know where the better fit comes from. I'm pressed for time, so I'm not going to explain all the ways in which the multinomial inverse regression model differs from that simple least squares regression under the dictionary approach that I told you about. But basically, the only thing that really matters, here's the point I want to make, at least in this setting, is the fact that the multinomial inverse regression approach operates on this giant vector of terms, 19,000, whereas the dictionary approach, and I forgot to tell you how many, the dictionary approach is operating on about 200 terms, which make up something like 2.5% of the entire corpus. So if I take the MNIR machinery and I apply it to only the terms that are also in the dictionaries, I get basically the same answer. So all these differences between the simple least squared approach applied to the dictionaries and MNIR, they don't amount to much if I require that they both operate on exactly the same information set. Okay, so that's the point of this picture. However, if I go to the full-blown MNIR, I get an enormous improvement in fit over the dictionary approach. And remember, the dictionary approach already had a pretty good fit. Okay, so basically I get an extra 20 percentage points on the adjusted R-squared from the full-blown MNIR. When I look at the firm level predictions, again, better fit from the multinomial approach, but the two approaches are telling us very similar things, both in terms of looking at R-squared across jump days, that's what you see here, and then looking across the firm level predictions themselves. So the two methods are giving us, in some sense, congruent answers. You're just getting a much better fit from the multinomial inverse regression. Now, I want to show you that this multinomial inverse regression is picking up much more in the way of explanatory power or accounting ability to account for abnormal returns than you would get from standard industry effects and standard financial controls. And that's what you're seeing over here. Okay, so this is just showing you the incremental R squared, adjusted R squared I get from going from the standard controls, including this NAICS 4 fixed effects, and adding in the what I get from the sufficient reduction projection. And these are big gains. Okay, so I just trying to make the point here that we're getting a lot from this MNIR machinery. What accounts for the fit? This is looking across a bunch of different methods and specifications. This is raw. This is a box plot of the raw data on these jump days. Okay, this is how much of the variation of the raw data I explain only from the financial controls. This is what I get when I add the industry controls, the detailed industry controls. If I drop the detailed industry controls and use the dictionaries, I get something very similar. If I use both the dictionaries and the detailed industry effects, this is what I get. But when I go all the way to the MNIR, I get a much wider variation in the predicted abnormal return. So I'm accounting for much more of the variation. Now, here's a limitation or a challenge in this MNIR approach, which is you got a great fit, but it doesn't help you. This sufficient reduction projection by itself doesn't have much interpretive value. It doesn't tell you where the fit's coming from in any direct way. So what we're going to do is we're going to unpack that. I'll show you how we unpack it. And in the course of doing that, I'm going to develop a method to automate the construction of dictionaries. Okay, so again, the dictionaries, the nice thing about dictionaries, they're kind of very transparent what's going on. And I'm going to give you an automated way to construct dictionaries that builds off the MNIR. So here's how it works. First, we take the multinomial inverse regression model and the inverse regression, and we look at the, we basically look for large terms in that giant feature set, 19,000 elements, that have very large values in the regression that is seeking to explain the frequency with which those terms appear. That's B1 in our notation. And we're going to look for large values just on an unweighted basis and also TF-IDF weighted basis. For those of you, I'm not going to go explain this other than to say the following. It upweights terms that are distinctive to certain firms, and it downweights terms that appear in, say, the text of all firms. Okay, the idea being that the distinctive terms are especially helpful in explaining the distinctive performance of certain firms. So I'm going to select seed terms, and I just basically make lists of A and B, and I just take like the top 25 of each one. Those are seeds. What might a seed be? Well, one of the seeds is tantalum. For those of you who know, tantalum is a rare earth that's used in optics and I think microprocessors too, but I'm not. So it's used in optics, and think of it as a supply chain into the kinds of manufactured products that who saw a big boost in demand from remote work and so on. So that's the first step. So that's an automated step. Second step is also automated. I'm gonna automatically build term sets that correspond to each seed. How do I do that? And I'm going to use these two criteria. I'm going to look for terms, they have to have the same sign in the return regression. And I want them to have high specificity. Again, I'm selecting away from terms that appear in almost all firms' text and giving more weight to terms that only appear a lot, but are concentrated in a few texts. But then I also I gotta have some way to know that I should think of oil and wheat. They're both commodities. So maybe I want to see they're similar. Or a simpler example is pipelines and pipeline. Okay, well, I probably want to treat them the same. So I'm going to use a standard method, a word to vec approach, which essentially defines, finds terms, to take one term like wheat, and you find other terms that are similar in terms of the context of surrounding words, okay? And I basically construct cosine similarity measures in five words before and after a word in question, and I basically come up with other terms that are used in the same way. That's how I fill out this, this term set. So this is all automated, and let me just give you the example. I don't see tantalum on this. So here's a seed. Preclinical was one of our seeds. And when we went through this method, that generated 43 terms. We looked at those terms, we called that drug trials. So this is the only human intervention at this point. And then we're going to also prune the terms a bit, okay? Things that look, don't look particularly helpful. So there's some human involvement here, but not much. Now I've got a bunch of new term sets that are generated from the MNIR. L is one of those. L of J is the name for one of those term sets. And I basically constructed new term sets. I can do this for each type of jump day. And then I'm going to go back to this same very simple regression as I had before. Okay, so here it is, except these exposure measures were generated by this automated process. So I've completely sidestepped the laborious process, which I've engaged in myself and other work of constructing expert-curated term sets, and gone through this largely automated method. Now, what do I get from that? Okay, so I'm gonna obviously get something that doesn't fit as well as MNIR because I'm not using all the information. The idea is to get most of the information or much of the information in an interpretable way using these kind of dictionaries, and it more or less works. So let's focus on the pandemic fallout days. Here's the adjusted R-squared of about 1/3 that I showed you in that very simple regression to start out with. Full-blown MNIR, I get an adjusted R-squared of 50%. This hybrid approach, I get 41%. So I've lost something, but relative to MNIR, but I've gained a lot relative to the expert-curated approach. And this, not only have I gained a lot in fit, but these are also interpretable categories, and I generated them in this semi-automated manner without having to use any expert curation. Now, I can run this regression again. I'm not going to walk you through the details of this table. Let me summarize what comes out of that when I apply this approach. I get a very rich characterization of what drives the structure of returns, and I've sort of summarized here. I pick up both upstream and downstream effects, as well as kind of direct effects of the COVID shock. If I repeat this exercise for, say, a monetary and fiscal policy responses, I again get a lot of explanatory power, but the categories are different, and the loadings on those categories are very different. So this has been kind of a whirlwind approach. I want to give you some chance to ask questions. Let me just do one more thing before I stop. So you're probably thinking at this point, how do I know there's not an overfitting problem going on here? We do a number of things to try to address that in the paper. One is just, it's important to understand that the machine learning method itself is designed to mitigate overfitting, but you can still have concerns about that. I know I certainly did. So what we're going to do is we're going to just take the models that were generated by MNIR to explain the cross-section of abnormal returns, and we're going to use them to explain something else, and something else in the future. And what we're going to use them to explain are future corporate earnings surprises. So remember, we fit the data, we fit the MNIR model to data in February and March of 2020. And then we're going to use those, the sufficient reduction projection that came out of the pandemic fallout days, the monetary policy days, the Super Tuesday days, to explain corporate earnings surprises in the third quarter of 2020 relative to forecasts. I'm sorry, this should say the fourth quarter of 2019, not the first quarter. That's a typo. And what do we, and here again, we're going to throw in a full set of industry fixed effects, financial controls, and so on. The bottom line of this table can be seen by comparing column 1 to column 5. And we're basically getting a very, a 40% increase in the fraction of the variation in the future corporate earnings surprises that is explained by these sufficient reduction projections that came out of the earnings model. So I'm not fitting the MNIR model to the corporate earnings surprise data directly. I could do that, that would be interesting. But here I'm simply saying that the things we learned back in February and March from fitting this model have a lot of predictive power for corporate earnings surprises 6 months later or so. Let me stop there and take questions and comments.
Now we are opening the floor for Q&A. If I may, Steve, I want to ask some questions. I mean, your talk is really informative and very, very stimulating. What I gather is that there are 3 components in your work. One is highlight the volatility and heterogeneity. The second part is the methodology to improve our understanding of what explains this heterogeneity and volatility. And the third part is that there's some economic contents, important economic contents in your conclusions. So I want to ask a question like this. If I still stay with the methodologies in the 70s and the 80s when we do event studies and we collect all these abnormal returns and regress them on whatever firm characteristics we can collect from statements and industries and so on and so forth, what do we gain using your methodology? And the second, and related to that is really, one of the things that we worry about using stock prices is that whether the stock prices are overreacting or underreacting, even though if the reaction is in the right direction. Can you shed light on that using your methodology?
Yeah, thanks for the questions, Bernie. Great questions. So on the first one, let me go back up a bit on the methodology. So I think in terms of what we've shown on the methodology in this paper is there's this machinery that Taddy's got one version of supervised machine learning. And a challenge in using that is interpreting results that come out.
All right.
What we've done is say, here's a simple semi-automated way to get easily interpreted results. You could apply that to many things. Here we applied it to explain firm level stock returns, but there's anything where you have a reasonably rich range of cross-sectional outcomes, you can apply this method, okay? Including many studies that have been done based on expert-curated dictionaries or based on kind of dictionaries generated by kind of more automated NLP processes that don't have this supervised character that MNIR has. Now, in terms of what we get relative to old-fashioned finance, I went quickly, but I showed you the dramatic improvements in adjusted R-squared that we got over and above a detailed set of industry fixed effects and standard financial controls. I can put more financial controls in there if you want. Instead of using abnormal returns relative to a CAPM model, I could use your favorite multi-factor model. I'm quite confident based on what we've seen so far that we're still going to get a big incremental improvement in fit. So part of it is just another way to say that is there's an awful lot of information encoded in the text that is not captured by the standard measures that we use and that we've been using. And I've seen that in other settings too. I mean, the whole economic policy uncertainty line of research that you mentioned briefly in introducing me, it's got the same feel to it. You know, there appears to be a lot of information in newspaper discussions of uncertainty that's not captured by standard macro statistics. How do I know that? Because when I stick it into kind of standard VAR type forecasting models, they have some forecasting power over and above standard stuff. So the same thing is going on here, except in this context, I think it's even more powerful effect, judging by the size of the increases in the adjusted R-squares. So I think I'm forgetting maybe one thing you asked me, but I want to stress, and I don't know if this came across well, that if the thing that was holding you back from using Taddy's approach or some other approach to supervised machine learning is, what do I do with the output? Okay, I think we've gone a long ways towards addressing that issue. I'm sure we're not the only ones. The machine learning literature is vast, and I'm kind of a novice in this area, but we think we have a simple method that can be applied in many settings to kind of lend interpretive value to supervised machine learning methods, and also to, if you like the dictionary approach, which I kind of do, and I've used it in many settings, here's an automated way to generate dictionaries rather than spend, I've spent maybe hundreds of hours, certainly dozens of hours creating dictionaries. And this is a much cheaper and less demanding of domain expertise approach.
Thank you, Steve. I really want to open up the floor. There are lots of great thinkers in the audience. If I may, let me relate a question to you. This is from Johan. Do you observe reversal for stocks on blue versus the red? Meaning
that was the part of your question I forgot to answer.
Yes, I'm intending to raise it later.
Yeah. So this. So let me answer that a little bit of a roundabout way. Yeah. So we've looked at that question intensely in another paper that we're working on. And it actually preceded this paper, but we dropped that one and turned to this one because of COVID. So we'd started down this path with these two methodological approaches to explain the stock market's rather extraordinary reaction to Trump's surprise election victory. That was a kind of a big surprise at the market level, but also another one of these days with extraordinary cross-sectional variability. And in that paper, what we find, and again, I don't know if we've got a working paper. I think we have maybe some half-finished, half-baked working paper out there on my website. But one of the most striking things that comes out of that paper is we don't find reversal, we find continuation. And in other words, if there were big responses in the cross section in abnormal returns the day after Trump was elected, and then you saw further firm level returns, abnormal returns, basically in the same direction for 2 more days, indicating that the market just was so stunned by what happened that it took a while to fully absorb the ramifications for firm level stock prices going forward. You know, we haven't actually looked at that so carefully in this COVID episode on the daily basis. But what we do look at, and there's a table in the paper on exactly this point. I didn't put it in the slide deck for lack of time, but we basically ask the following question. Suppose you take these, all of the abnormal returns over the COVID-19 fallout days, and you look to see, well, what, instead of looking at the daily returns, look at the returns over the next 3 months, 6 months, 9 months. I think we went all the way to the end of 2020. You basically see that through the end of 2020, the same patterns hold up, and with pretty high R scores as well. So we don't see any strong reversals. We haven't looked at a very high frequency temporal way as we did in this other paper, but we did look. You basically see those patterns that kicked in the day after bad COVID news were basically still there 3, 6, and 9 months later.
Thank you, Steve. We'll go further into this kind of economic questions, this kind of questions later. But let me just relate two questions that pop up in the chat box. One is by Johan, and he asked the question: do you observe reversal for shocks on the blue versus the red, meaning the policy versus the COVID days? And are the shocks in the bottom quintile on blue days more likely to be in the top quintile during the red days, and vice versa? So that's his question. And there's another question by Anand, but let's just deal with Johan's question first, please.
Yeah. So I think the red days were the COVID fallout days, if I remember right.
The red would be illness, and the blue is the rescue.
Yeah.
The policy.
Yeah. Okay. Fine. Yeah. So there's no doubt, as having lived through that time period, but also if you read the newspaper articles, these monetary and fiscal policy responses were aimed at countering the economic effects of COVID. Okay. So that's part of the question. Yes, that was their intention. However, what the results say in the paper very strongly, and I didn't have time to go through this, is the cross-sectional reaction of stock returns is radically different on the monetary policy days or the fiscal policy days than it is on the COVID days themselves. So maybe at some aggregate level, those policies had some success in mitigating the economic damage caused by the pandemic itself, but at the micro level, they're not mitigating. They're just causing a very different set of effects. So I think that's important to understand for a couple of reasons. At least we, and I'm speaking as a macroeconomist now, we have a tendency to think about things at the aggregate level and to ignore the stuff that doesn't average out. If your goal is to use monetary and fiscal policy to kind of set things back to where they would have been absent the pandemic, I would say they didn't do that, at least according to our study. If your goal was, however, to mitigate some of the aggregate effects of the pandemic, well, they had quite a bit of positive effect in that direction.
Thank you, Steve. I'm going to do the following. I'll relay a question by Anand to you, and then I'll ask Danny to raise the question. Danny, you're on the panel list. You can directly speak. So let me go to Anand first. His question is: was there a big difference in the shock days versus other policy days in terms of R square? In terms of the R square.
I'm thinking back. We basically get big adjusted R squares on all the days. I think they're lower on the policy days than on the COVID days, and the highest is actually the oil price shock day. Maybe not surprising that there was one of the jumps. You can think of that as triggered by the COVID pandemic itself. But if you read the next day newspaper accounts, that's not how they characterized it. They characterized it as a massive collapse in commodity prices, which, that's kind of the level at which they characterized it. So that day also had a very high R squared. But no, on all the days that every class of day that I showed, we've got R square adjusted R squares of like 0.25 or above, if I recall correctly, using multinomial inverse regression.
Thanks, Danny.
And you saw that actually. I showed you a picture very quickly. Yeah, go ahead, Danny. Good to see you.
Thanks, Bernard, for letting me ask a question. Hi, Steve. Really nice talk. My question is: when you compare your own human-constructed expert dictionaries with those that you backed out from MNIR, do you recall, just looking through that, scanning that, what the most surprising deviations might have been for you? Like, say, under inflation, you had your own terms. What did MNIR come back with? Were there things that you looked at and said, oh, yeah, of course, I should have included that in the first place? Thank you very much.
Yeah. Thanks, Danny. Good question. So I don't know if it was the big surprise, but there's considerable overlap, but the really big difference is MNIR is just much, much better at picking out exposures that are tied to where a firm sits in the input-output structure. Okay, it is, we captured very little of that in our dictionaries. Maybe that's a reflection of our lack of imagination in constructing the dictionaries. And there might be something that, but I don't think it's entirely that, because like I used the tantalum example as for a reason. It picked out what you would think in advance is a rather subtle feature of the global supply chain. But it turned out that it picked up stuff that was really important. So in the tantalum category, you find mostly other rare earths, things that feed into the supply chain for optics and processors, but you also find the Democratic Republic of Congo. Well, why is that? Because that's where a lot of these, outside China, that's where a lot of these rare earths come from. It's a place subject to considerable geopolitical uncertainty. So I'd say the MNIR was just much, much better than we were at detecting aspects of the input-output structure and the global supply chain that matter. And that was despite the fact that we did nothing at all really to help MNIR tease out aspects of the input-output structure. And you can easily imagine, and we may do this in a future paper, or maybe somebody else will pick up the ball, taking what we know about input-output structure from other sources. And this is an area which there's been tons of work in the last decade or more. You can expand the feature set to have things that have information about the input-output structure in a number of ways, either based on the firm's industry, or there's some information in CompuStat about who your major customers are. That's another way to go about it. And include that stuff either as standalone features or things that are interacted with terms in the texts. We haven't gone down that path yet, but based on what I see, this strikes me as a machinery that can be used to draw out the input-output structure in a much more granular way than has been done previously, mainly using industry-level input-output matrices. So I'm not sure I've got the comparative advantage to work on the I/O aspect of the input-output structure, but that was the biggest thing that really struck me.
Thank you for the question, Danny. And Steve, I want to ask a quick question raised by Alodin, and then I want to shift a bit towards the economics. Okay, the question by Alodin is whether you have looked at this through the trading activities, how the trading activities react to shocks. And the economic questions that I myself want to raise is this. Your beginning part and all this stock price reaction shows a lot of firm level heterogeneity, ups and downs. And so it seems that the market is telling us that there will be a huge amount of adjustment in the marketplace at the firm level, at the industry levels, and so on and so forth. So what should we pay attention to? And also, I'm thinking about in Asia, how should we think about it? I mean, the capital market adjustment in Asia, is it a concern? Is it not a concern? And given that we have a global challenge in making all these adjustments. So trading activities and the adjustment question.
Yeah, I'm not sure I understand what's the meaning of trading activities in this context.
Alodin, you're on the panel. Can you raise your question?
Sure. I think the question is whether do we see, institutions reacting to this shocks in a way that, does it take trades to move these prices, or do they just move without much trading going on, right? So to the extent the volatility is driven by trading activity versus just reacting to the news.
That's a great question. I confess we haven't looked at that at all. I don't even know, and I'm sure you do, but I don't even know what the landscape is for data at a daily frequency on firm level turnover. But we could treat that as an outcome variable, or we could take the covariance between the volume measures and turnover volume measures and share price reactions as an outcome measure. We've done none of that. There's already a lot in this paper, so I'm sure we're not going to do it in this paper. It's a great question. And you got me completely flat-footed. I have no idea what the answer is. So maybe somebody will pick up and run with that.
Okay, that's I think it's also related to how prices maybe overreact, underreact. These things are all still related to some extent how much trading that we see in the market. Yeah,
and we did try to get at that a little bit in this Trump election paper that I described, and there is some evidence. I wouldn't say it's super strong that the continuation effects that I sketched before were more pronounced for smaller cap stocks, which you would think would trade in thinner markets, right. Which I think is the direction of that you're going there. So we did find a bit of that, and I think if we explore this kind of volume issue, we're probably going to do it more in that context. I think these thin market effects, if they're present in the data, and here I mean thin, not just in terms of volume, but thin in the depth of information that traders have that would give them comfort to trade quickly. I think that notion of market thinness was especially pronounced in the wake of the Trump election surprise, and I'm not going to go into why I think that here. Not enough time, but it's a good question. I'd love to see somebody pick that up and it's kind of more into that side of the literature than I am. I'm already enough of an interloper in finance. In this talk, thank you guys for letting me talk.
Hello, Dean. We'll go into it. The economic adjustment question.
Yeah, on the economic adjustment question, so I put this slide back up, and so actually both before and after we wrote this paper with a different set of co-authors mostly, I've got papers that look at real side measures of reallocation activity. So and we do see a lot of reallocation. I'm going to refer you to like a couple of other papers. There's Nick Bloom and Jose Maria Barrera and I have a paper published in the Brookings Papers on Economic Activity in the summer that was titled COVID-19 is also a reallocation shock. And that paper provides quite a bit of evidence to back that claim up. There's later work that I've done with Nick and Jose and independent work looking at stock prices, again in the US, which points to the reallocative effects associated with the working from home, the shift to working from home. So that shift involves both industry level shifts in demand, reduction in business travel, an increase in demand for, Zoom's stock price, responded rather favorably to the COVID-19 pandemic, among others. I lost my train of thought there. So you can see, there's also a spatial component to the reallocation. That's the other thing I wanted to say.
You showed the convergence in expectations between employers and employees about working at home?
Yes, we look at that. Both employers and employees expect a lot more working from home after the pandemic is over. Their desires are not fully aligned. Workers would like to work from home more often than employers would like them to. So there's a tension there, and we'll see how that plays out. But the other thing I wanted to mention in this context is a paper by Schmidt and Papanicolaou, who actually, I think I borrowed a picture from them. I'm going to show you real quick because it tells the story much better than I can in words. I believe I put their picture. Here it is. This shows you, this is sorting firms into industries and then industries into buckets, quartiles of how exposed they are to a shift to working from home. And basically what you see is that in late February and March, there was a huge widening of cumulative returns relative to January 1 across these quartiles. Firms that were well situated to accommodate a shift to working from home did relatively well. Those that weren't did relatively poorly, and that basically prevailed through the end of 2020. So the equity markets are telling us that this is one dimension. So this aspect of the Schmidt Papanicolaou paper is very much consistent with the non-financial data that I focus on in my work with Bloom and Barrero. So yeah, I think there is quite a bit of evidence that this heterogeneity, this dispersion of returns has been manifested in the succeeding 15 months or so in a dispersion of real side outcomes.
Well, Steve, thank you. And this is really a very educational, very helpful, stimulating lecture. Thank you. And I want to thank the audience for participating and all the very good questions. Before we say goodbye, can I ask you to say the following? This is ABFER, I think about Asia. What are, in the current context, the kind of work that you're doing, what are the pieces that you want to see doing in Asia? And maybe then the audience can write to you and say, let's co-author. Any suggestions? Just name 3.
Well, I've got some work on China underway already that is in the spirit of what I talked about in the beginning of my talk. So, you know, using newspapers, both mainland Chinese newspapers and Hong Kong newspapers, that's one source of text. But think about what I did today. I basically took a text source, which is describing something about firms. But it doesn't have to be, I used regulatory filings, but it could be analyst forecasts and the verbiage around them. I think of the machinery that I talked about today as being applicable to a very wide range of asset pricing questions, most obviously because you have the high frequency return data, but also to corporate finance data if you've got firm level outcomes and you want to explain and interpret those, and move beyond the standard set of measures that we use all the time. There's just this, the way I think about this text-based area, there's just mounds and mounds of raw text sitting out there waiting to be turned into useful information. We have the computing speed to do it now. We have the digital archives in many cases that provides the text, and we have these methods that can be applied. So I just see it as it's a gold mine for empirical researchers. So go for it. There's just a million different directions to go in, and I can't possibly, even with large numbers of co-authors, pursue them all on my own. So I hope others will join the bandwagon.
Well, thank you, Steve, and thank you for the audience. I myself have a good time, and I also hope that you find this really stimulating and very educational. And Steve is beyond midnight, so another really thank you. I hope that you can have a good rest tonight.
I look forward to seeing everybody in person at the next ABFER, if not sooner.
And for the audience, thank you for being here. And by the way, some of the things that we have discussed, you can find some related papers in the ABFER programs, like the newspapers in China and so on and so forth. You can find them, and I hope you enjoy them. And last but not least, I want to thank our team, which worked so hard to make all the events seamless. So thank you very much, everyone. Have a good day. And for those in North America, have a good night. Rest well. Thank you.